Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in Accounting, and our topic today is disposing of planned asset. And guys, subscribe to our channel. You will be the first one to know when a new video arrives. And here, no PowerPoint on this video, only Excel. And guys, all our Excel files are free, and the link to download it is in our video description. So let's go. When we make the disposal of any asset, we have three possible scenarios. Transaction 1, 2, and 3. For instance, a plant asset, the book value is 10. We can sell it by 10, no gain and loss, 11, a gain, or 9, a loss. So, how do we do that? First of all, if we are disposing the asset, we need to close the asset account. And remember, asset is a normal debit account. So we need to close it. We need to do a credit. So let's do the first one. January 2nd. Receive cash from sale of shelving unit, $500. Original cost, $8,500. Total accumulated depreciation through January 2nd, the day that we sold it, $8,000, receipt number 543. So our original cost, $8,500. So we need to credit it. So here, equipment, let's credit how much? $8,500. Now, receive cash. If we receive cash, our cash is a debit. And doc number receipt 543. How much? $500. Here, guys, what is our problem? If we don't have the asset anymore, we don't have the accumulated depreciation anymore. So we also need to close the accumulated depreciation. Accumulated depreciation is a contra asset account. So regularly it is a credit account. We need to close it. So we need to debit. So accumulated depreciation, and it's a debit. So let's move here. Debit $8,000. Debit $8,500. Credit $8,500. No gain or loss. Cash, we need to go through cash journal, cash receipts journal. So date, January 2nd. Account title, equipment. Doc number, receipt 543. Equipment here is a credit. One of the only scenarios that we use credit on cash receipts journal. What else? Accumulated depreciation. So here equal to this one. Accumulated depreciation, a debit, $8,000. And the cash debit, usually on the first row, cash debit, the 500 remaining. Whoa. Let's change this some formula here. You should be looking at the right one. I have no idea why it's not working. So here, sum of debits and credits, 85. We are good. Okay. Much pretty. So, perfect. Let's go to the second transaction. Receive the cash from sale of desk, $850. Original cost, accumulated depreciation, so the same. So here, May 1st. And here, sale of desk. Let's call it furniture. So what do we have here? The same, receive cash. Receive 582. How much? 850. Now, again, we need to close the accumulated depreciation. How much is the accumulated depreciation? 1,300. And we need to credit furniture. Whoa, come on. Furniture. A credit. How much? $2,000. And here is not a credit. It is a debit. Now we are good. Let's check now. We have more debits than credits. We need credit here. So if we need credit, how much? The sum of debits minus our credit, 150. Credit, let's think about income statement. Revenues and gains, they are credit accounts. Expenses and losses, they are debit accounts. So we have credit here. It is not a sale of any goods. We don't sell furniture in our company. So gain on disposal of assets. And then here we go. But cash. So let's go here on cash. Cash now. Furniture, it is a credit. Furniture, a credit. Receipt 582. What else? Usually we go through accumulated depreciation. That is a debit. And finally, the gain or loss. Here is a gain. So gain is a credit. 150. And the cash debit, 850. And sum of debits and credits, they are good. So how do we do the sum of debits here? Debit, we have only this one, debit, sales discount debit, cash debit. So it's the sum of our totals. And this is the total sum of our rows. And sum of the credits, we go through credits until sales tax payable credit. So credit, 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 credit. So we sum these ones here and debit this one plus that one. Okay? Let's go through the last one. So October 6th, the same cash sale of a computer, original cost, total accumulated depreciation, receipt. So again, cash, but it's here because it's a debit. Receipt 645. How much? Receive cash from a sale of computer, 200. What else? A accumulated depreciation. How much? 3,300. And computer, let's call it. It is a credit. $3,800, the original cost. What do we have now? We need a debit. So what do we usually do? First, on a journal entry, all of our debits, all of our credits. So let's move this computer to this one. But if you do debit, debit, credit, and debit, it is not wrong, but it's not usual. Okay? Here we need a debit. So if the credit is gain on disposal of assets, the debit is loss on disposal of assets. And here, how much is the loss? Credit minus the sum of debits. $300. And now our debits and credits are good. Cash journal. October 6. Computer. Receipt 645. We have a credit 38. And guys, there are some textbooks that they don't do the general journal when we have the cash journal as well. Completely okay. Okay, so this is the most complete one, but if you wanna summarize it, you don't need the general journal, only the cash journal. So pay attention what your instructor is telling you to do. Okay? Now accumulated depreciation. Accumulated depreciation, a debit, 3,300. And loss on disposal of assets, 300. And now our cash debit, $200. And here the sum of debits and credits are good. So guys, these are the three scenarios, the three only scenarios that we have. So watch this video how many times you want. Questions or comments, leave it here or email me at jscarpin@gmail.com. Have a very nice day and God bless you.